Manish Sonthalia joining in right now as Director and Chief Investment Officer at Emkay Investment Managers. Manish, very good morning. I think what
Good
will be
morning.
really, interesting to understand is how you are looking at this. Are you looking at it as an opportunity? Are you looking at it as a time to duck and cover? What is the investment philosophy in the middle of all of this turbulence?
So, Tamanna, a known uncertainty is better than an unknown uncertainty. So now it is a known uncertainty, and 25% is no longer the base case, it is 50%. Having said that, I think we have to look out slightly into the future. And you can say that we are making a base case assumption that these tariffs are not going to stay at these levels, likely to come down into the future because US has got significant investments into India, particularly in the area of electronics manufacturing, particularly in the area of specialty chemicals or let's say auto components, etc. Whether these investments will be subject to these 50% tariffs, I mean, it looks unlikely. So, I mean, my base case assumption is that probably in the next 3 or 4 months, you would broadly be seeing these tariff rates come down to around what other countries would be paying. And in that backdrop, and given the fact that a lot of these uncertainties have got priced in, I would look to basically buy these markets. I don't think there's too much left on the table as far as uncertainty is concerned. Of course, you should be focusing on areas of domestic presence as opposed to exports. That's likely to be the case, but nothing moves the needle significantly in terms of swinging the pendulum from a bullish stance to an extremely bearish stance just because these numbers have come through. For the simple reasons, and you could say that there could be a second order impact because exports and manufacturing are very important for any economy. Direct impact as of now is a half a percentage point on the GDP that could be mitigated through policy intervention by the central bank as well as the government of India. So this is where we are currently, and it's likely to be a pick and choose. I would be looking to buy the markets. I'm not so nervous about the markets, given the fact that these sort of tariffs have come through.
Right, that's interesting, Manish. Good morning, Hiral on this side. I mean, the consensus that we're picking up also right now is that, one should be looking at buying opportunities in this kind of a market. So, Manish, taking that aspect into consideration, you said, yes, domestic-oriented sectors is your go-to place. So anything that is insulated from Trump tariffs are the sectors. What would be your top 3 picks in terms of sectors that you would advise investors to go, taking into consideration the valuations as well, because you just have the first quarter earnings that have come in. So if you have to look at both these combinations, where would you go?
So, coming to first quarter numbers, they haven't been that bad as it's being made out to be. I would believe that Nifty 50 earnings growth for the companies that have still reporting the numbers, or companies which have reported the numbers so far, has been around 6 to 7% profit growth on a YY basis. Mid cap companies are double digit 13 to 14%. Small cap companies, financial sector is in a stress because of the MFI. But if you were to exclude lending institutions in the small cap space, even out there, the growth in net profits on a YY basis has been double digit 15 to 16%. Given all of this, I think consumer sector looks to be placed in good stead as we progress into the second half of this year, given that there's further decrease in inflation trajectory anticipated in the second half. So 2% inflation could come down to 1%. That helps consumption at the margin. You have very solid numbers come out of capital market entities, the financial services, non-lending institutions, and they would be somewhat in the nature of platform companies, not getting too much of impacted by whatever is going on in the economy as a whole. I would look to buy NBFCs, which have been placed in good stead. I would look at CDMO companies. They won't be getting impacted that big. And even in the export side on the technology front, I think mid-tier IT companies, given the valuations and the order book position, are looking good at this point in time.
Manish, just reiterating one point very quickly, you said, I'm looking to buy. I'm not feeling nervous. When you're looking to buy, would you also be looking at what the corporate performance would be? What are the kinds of companies? You've mentioned some already, but what are the kinds of companies that you'd stay away from right now?
Very high valuation, because valuation is the only thing that you should be worried about vis-a-vis the growth. So first of all, if markets Nifty 50 is trading at, let's say, 2 times price earnings growth, you would be looking, and I would be looking to buy basically companies having earnings growth better than Nifty 50 and valuation trajectory lesser than Nifty 50 PEG. If that be the case, across market cap, there's ample margin of safety. So I think the yesteryears or last 2-3 years, high performers in railways, roads, and defense are the vulnerable ones because there could be government spending cut. Thanks to a slowing economy, that could hurt the capital goods players because valuations are extremely full. Even otherwise, in all of the companies vis-a-vis the growth, that 3 price earnings growth multiple is very, very sacrosanct, time tested. I will be looking to just evaluate all the performances of companies that are to be bought vis-a-vis that valuation benchmark and then, maintain the portfolio.
Thank you so much, Manish, for joining in today and giving us that voice of confidence as well. And I mean, these are people who look at it for what it is, not sentimental or anything like that. And they're looking at safe spots in the markets. Markets also showing some recovery.